Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 28th of July. I'm Daniel Lam, your host for the podcast. With the strength in US equities, a number of our clients have been asking, what can derail this rally? Well, so far, the combination of receding US policy uncertainties, resilient fundamentals, and a squeeze from previously bearish positioning has led US equities higher. So, to sustain this rally, we need to see whether the Trump put remains intact and if US resilience holds. The four signposts to watch out for are non-farm payrolls, goods inflation, earnings momentum, and correlation amongst US assets. So far, the US has avoided a tariff-driven slowdown. Second quarter GDP is tracking at 2.4% year over year, which is above consensus at 2.1%. While high-frequency activity indicators, such as the Dallas Fed's weekly index, have rebounded from their fall in May. However, the key risk is negative payrolls. So while not all the recessions will start from negative payrolls, almost all include that. So a succession of negative prints would be a signal of a recession. Secondly, tariff-driven inflation. So this looked like crying wolf for quite a while, until some signs of a pickup in goods inflation in the most recent inflation reading, which is offset by some cooling in service and shelter cost. A broad-based pickup in goods prices would signal tariffs are indeed feeding into inflation. Thirdly, a turn in earnings momentum. Now, corporate earnings have thus far been resilient, sustaining the rally. A weaker US dollar, improved company guidance, and lowered expectations have set the stage for positive earnings surprises. Earnings leading indicators and revision indices remain supportive, but with valuation stretched, a loss of momentum could weigh on equities. Lastly, we need to watch out for a revival of US unexceptionalism fears, which we saw back from the April tariff shock this year, which resulted in correlated declines of the dollar, equities, and bonds. Now, these fears have since eased, with the US dollar resuming its typical negative correlation to equities and broadly tracking rate differentials. However, should the US dollar fall alongside equities or decouple from rate differentials, that would signal the return of those fears, putting renewed pressure on US assets. And the test that we're going to see is going to be the 1st of August tariff deadline. Should Trump follow through with his tariff threats, a sell-off in US assets would signal the return of US unexceptionalism fears. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.